Hello, students. This is Professor Watts, and welcome to the first lecture for INTV 440, International Finance. This is going to be a quick overview of an international business environment, introduce us to some topics and themes that we're going to be addressing in this class. So let's get started. We'll look at four things, and this is aligned with Chapter 1 from our textbook. So just a basic rationale of globalization, what globalization is, and why it occurs, why it's really inexorable. What are multinational corporations, MNCs? We're going to talk a lot about multinational corporations and their operations. We're going to look at some features of international finance as distinguished from domestic finance. And then finally, we'll take a brief look at goals for international financial management and how those might be different across different countries. So let's start with the idea of globalization. Now, I'll take us back to principles of microeconomics, and a big theme that I hope you were exposed to there, I certainly address this when I teach Econ 201, is that specialization leads to trade, and trade leads to wealth. This is really the core theme or core lesson in your principles of economics. In fact, Adam Smith, kind of the founding father of economics, back in the 1700s in his classic book, Wealth of Nations, he talked extensively about this. And he talked about how when you have division of labor, people specializing in very particular tasks, they can become immensely more productive. But you have to have trade for that to pay off. Because if you only make one thing, like let's say you only make toilet paper, well, you can use a little bit of it, but you need a lot of other things, right? You need a house, you need food, you need a car, you need clothes. So you have to have other people to trade with who specialize in the things they produce. And that works better when there's more people that you can trade with. So Adam Smith summed that up by saying the division of labor is limited by the extent of the market. In other words, the number of people you can trade with. If you don't have a lot of people to trade with, you're not going to have a lot of division of labor. Imagine like living on the frontier by yourself. You're going to have to do almost everything for yourself. You're not going to be really good at anything because you're not specializing. But if you're living in a large country, you can trade with people from all across that country. Well, if you're living in a globalized economy, you can now trade, maybe in a country, you can trade with millions of people. In the global economy, you can trade with billions of people. So division of labor can really take off in that setting. Okay, so we'll summarize that by saying global markets allow for the largest possible extent of the market. In other words, number of people you can trade with, and therefore more basis for specialization. So there's huge opportunities for the gains from trade that we know will occur because of specialization and division of labor when we're looking at a globalized economy, a globalized market system. The only other thing I want to say about this, we could talk about the history of globalization. We could do a whole class on it, actually. Globalization is not new. It goes all the way back basically to the beginning of human civilization, where people realized that other parts of the world either had natural resources or had people who could do different tasks. And so there was opportunities for gains from trade, and people realized that since the beginning. So we've had foreign trade pretty much throughout human history. However, we had the Industrial Revolution in the 17 and 1800s, and then we've had the Information Revolution in the 1900s and the 2000s. And those have just created ever expanding opportunities for gains from trade because we have lower cost of transportation. Basically, transport has never been cheaper than it is now. Just think about the opportunities you have to travel with cars, trains, buses, airplanes. It's never been more accessible. It's never been more affordable. And then, of course, communication as well. Communication is approaching free, with the cell phone network, with the internet. It's just amazing the opportunities we have. So we can expand the extent of the market globally like never before. And profit-seeking entrepreneurs are going to do that because they know that they can increase productivity and efficiency and profits by operating on a global scale. Let's talk about this issue, though, next of the multinational corporation, MNC. You'll see this referred to constantly in our textbook. A firm that operates in multiple countries. So it's based in one country, but then it operates in other countries. And a lot of times MNCs make most of their money outside of their home country. So they can be headquartered in a relatively small country, and they can do most of their business abroad. Okay. According to the book, there's about 60,000 MNCs in the world. And you only have to operate in two countries to be an MNC, right? So some of them will be relatively small, but a lot of them are huge. A lot of them, in fact, are huge global brands that almost everybody recognizes. What's the relevance of an MNC? Well, as we talked about, extent of the market. The more countries you can deal in, the more you can take advantage of division of labor. And specifically, an aspect of that is economy of scale. You lower operating costs and you gain efficiencies by scaling up production. And a lot of the early MNCs were businesses that realized they could cut their costs if they could just get their production scale up. Well, they had saturated their own local markets. So where do you go when you've kind of exhausted the customer base in your own country? Well, you go to other countries. So a lot of MNCs got started by doing just that. They tapped out their domestic customer base, so they started searching for customers abroad, and hence MNCs were born. Also spread your R&D expenses and your capital expenses over the much larger global sales. You get better purchasing power. Big players can make better deals. Here's just a couple of examples of multinational corporations that you might know. I really just got these off the top of my head, and I tried to think of ones from different parts of the world. So the U.S. one, I've only got one U.S. one here. Of course, there's many. Ford. And this one I've researched a little bit. Ford is one of those multinationals that got started by simply saying, well, we've kind of maximized our domestic customer base. We want to keep selling and keep growing. So they started selling cars abroad. And that was really about 100 years ago. Ford has been multinational almost since the beginning of the company. They sold Model Ts in Europe and South America and Africa. You probably recognize Toyota. Toyota's made a lot more money globally than they have in Japan. They're also huge in Asia and Africa. You might go shopping at Aldi. That's a German-owned multinational grocery store chain. Very low cost, very efficient, and very nice place to shop if you're trying to feed a large family like I am. You might be familiar with the Lever soap brands. Unilever, it's kind of a soap and cosmetics. That's out of Great Britain. You might have ridden on an Embraer airplane. They make kind of the small regional jets. They're out of Brazil. You might have Michelin tires on your car. In my opinion, the best tire in the world, actually. They're out of France. You might have heard advertisements for Mahindra tractors. They're out of India. You might have heard of Woolworth. Well, not the Woolworth, the old drugstore, five and dime store, but.
And stay out of the Woolworth.
There's a company called Woolworths in Africa that operates stores all across the continent of Africa. So just a couple of examples. Of course, there's hundreds of these, and there's a lot of brands there's a lot of brands you don't, but it is a very prominent part of the global economy, multinationals. Okay, let's move on and talk about what's so special about international finance, what makes it different from just finance within one country. Well, most of the things are going to be similar, financial principles and accounting and valuation. The methods are going to be the same, but there's going to be issues that we have to contend with. The biggest one is risk. Now, when you see risk, you probably think about things can go bad. That's true, but that's only part of risk. What risk technically means is that there are just more possible outcomes to contend with or to think about. They can be good and bad, right? So more possible things that can happen. It's just harder maybe to plan and adjust to them. They don't have to be bad things. A lot of times we focus on downside risks, but there's also such a thing as upside risk. Now, let's talk about specific international financial risks that we are going to be really concerned about in this class. One, and probably the biggest one we'll focus on, foreign exchange risk, and then we'll talk about also political risk. Okay, then we have the issue of market imperfections, and then the expanded opportunity set businesses face when they go global. Now, the source of these risks is that you're dealing with separate countries that have their own governments, and those sovereign governments can issue their own currency. That's going to be the source of foreign exchange risk, because now we have to trade one currency for another. They can also implement their own economic policies, taxes, regulations, trade restrictions. They can seize assets of foreign companies. There's all kinds of things that these countries and governments can do, some good, some bad, that a company has to contend with. Okay, let's focus on this issue of foreign exchange risk for a minute. So if you're a US multinational, let's say Ford, selling cars in Europe, you're going to sell those for euros. You have to convert them to dollars. Well, if the euro goes down against the dollar, you'll come out ahead because the euros you earned are going to be worth more dollars. If the euro goes up against the dollar, you're going to lose some money because you get fewer dollars in exchange for the euros when you bring them back. So we have the issue of what's called translation risk, bringing foreign currencies back home. We'll talk a lot about that later on. Personal anecdote here. I was fortunate enough to have won an essay contest when I was a young, starting off professor. It was by an outfit out of Europe called the European Center for Austrian Economics Foundation. And I won 5,000 euros. And there's my ceremonial check. Now, that wasn't actually what I took to the bank, that was just for the photo op. By the way, you can tell it's Europe there because they put the date as month, day, year rather than day, month, year. But anyway, I had to bring 5,000 euros home. And, I was thinking about, well, should I bring the euros home and then wait for a favorable exchange rate? Or should I exchange them for dollars in Europe and bring the dollars home? So I had to make a decision. Now, is it going to matter for me? One time, 5,000 euros, not that much. But imagine you're a multinational corporation and you're earning 5 million euros on a monthly basis. Well, then small movements in the euro dollar exchange rate are going to have a big impact and add up over time. Let's talk about those political risks. Foreign government, for example, can nationalize a multinational corporation's local plants. This is actually a pretty frequent occurrence. US companies, for example, build plants in Mexico, Argentina. There's a revolution, a new government takes over, and those new governments decide that they're going to seize the assets of the imperialist foreign companies. Well, that's going to be a huge loss for the multinational company operating in that environment. Foreign governments may also impose new taxes or trade restrictions, makes harder to operate, reduces profitability. Now, remember, risk can be both bad and good. So here's an example of a upside political risk. A foreign country joins a trade bloc and gains market access. So this happened with some Eastern European countries who joined the European Union and then got access to the euro and got access to the integrated transport and labor market of Europe. So if you were operating in an Eastern European country and then they join the euro, now conditions have improved and your profitability probably improves as well. Remember, risk is not just bad stuff, also good stuff. It's just that there's a huge, larger array of possible outcomes to contend. Okay, market imperfections. I'm not going to talk a whole lot about this, but it basically refers to markets not working as well, largely due to different institutions in different countries. So that would refer to the laws, regulations, taxes, corporate structures, and that makes things that creates these frictions where things don't work out smoothly like they might within one country with one set of laws and regulations. Finally, the issue of an expanded opportunity set. Expanded opportunity set, pretty self-explanatory. You have more opportunities to make money to sell your product. And the way I want us to think about this is the biggest opportunities for MNCs often are going to be in undeveloped economies. Why? Because undeveloped economies, poorer countries, if they can get on a proper path for their economic system and their institutions, their laws, their taxes, and so on, they will achieve faster economic growth. And the reason for that is that countries that haven't grown yet have more potential to grow. Think about it if it were people. Okay? Who has the greater growth potential? A young boy or an old man? Right? Well, given proper nutrition, right, the young boy is going to keep on growing until he reaches adulthood. The old man probably actually physically declining. You want to get into undeveloped economies, provided that you have assessed the risk of the bad things that can happen versus the good things that can happen, and you think it's a net winner. Okay, finally, let's talk about goals for international financial management and how that differs from domestic corporations. So, in the textbook talks about the Anglo-Saxon model. Now, the Anglo-Saxon model, think about the Anglo countries, which would be Britain, and then the Anglosphere, countries that speak English. So Great Britain, the US, Canada, Australia, New Zealand, Actually a few others. Some people even put Hong Kong in there because Hong Kong's institutions were deeply influenced by Britain. And then Saxon would be mostly Germany or Northern Europe. So you're talking about the Anglosphere and Northern Europe generally operate on the model of shareholder wealth maximization. So the firm's goal is to maximize the value of their shares, their stocks. How do they do that? Well, you probably know from your other finance classes, I hope, or you will learn this eventually, that a company's share value or stock price is just the discounted value of the firm's future cash flows. Discounted cash flows, DCF. I hope that's familiar to you. Should ring a bell, especially if you're a finance student. So you want to maximize those future cash flows, and you do that by investing in marketing, gaining access to foreign markets, coming up with better products, doing a better job selling them. Right? So it's all about maximizing cash flows and profitability. It's all about the bottom line. There's another concept that says stakeholders matter. Stakeholders include employees, suppliers, customers, banks, kind of the larger society. What about them? The stakeholder model says a company should only be focused on profit. It should be focused on creating the best outcome for society and for the people who have interests in its operations. So I'm not going to get into the details on this. You probably have heard about this if you've been paying attention to kind of the corporate world and discussions about management. But I'll just close by saying that there's this shareholder versus stakeholder model debate, major controversy, and it's going to be an ongoing controversy. What we want to be aware of in the context of international finance is that there's different views across different countries, and those are both for economic and cultural reasons. So that's something you want to be aware of. Culturally, some countries are more focused on profit and shareholder wealth maximization. Other countries are more focused on community and a company's interest in kind of taking care of its stakeholders. So we'll get into that a little bit towards the end of the semester, and we'll maybe look at some examples to talk about some of those cultural differences. And that's just something for you as a student to be aware of. Okay, so one more thing we'll talk about here is corporate governance. Corporate governance basically says, how do we get the people running the corporation to act in the best interest of the shareholders, assuming we're going with that shareholder wealth maximization model. If we're going with the stakeholder model, we would say, how do we get the people running the company to act in the best interest of the stakeholders? So it's basically the same problem. And in economics, the jargon for this is known as the agency problem. Managers will pursue their own self-interest. That might come at the expense of shareholders or stakeholders if they are not closely monitored. If we don't have some kind of regime of rules and incentives that gets the managers to act in the interest of the shareholders or stakeholders. It's generally considered that agency problems are a big weakness of public corporations because you have a kind of a separation between the ownership of the company, the shareholders, and the people running the company, the managers. And the managers have a lot of leeway to engage in what we would call opportunistic behavior, kind of feathering their own nest or not working as hard as they might, or doing things that are in their own short-run interests but are detrimental to the long-run interests of the company. So we need mechanisms and institutions that will kind of curb that if we want to maximize shareholder or stakeholder wealth. So that's what corporate governance is all about, regulating the relationship between management and shareholders or stakeholders to kind of curb those agency problems that are always prevalent when you have a different set of owners and managers. Okay. Institutions, again, are what we're talking about when we talk about corporate governance, laws, regulations. Those come from the government. Corporate structure might be imposed by the government, but companies might decide on their own that they want to structure themselves in a particular way in order to optimize over incentive problems related to agency issues with shareholders versus management. Now, again, why do we bring all this up? Well, we want to be aware of differences across countries. Some countries have very specific laws and regulations designed to control the agency problem that are lacking or that are different in other countries. So that's a thing that you want to be aware of if you go into international business. And as we say in econ, if you change the rules, you change the results. So you want to be aware of how the rules are structured. All right, so let's wrap up by talking about what we're going to be doing in this class. Well, we're talking about financial risk management for MNCs primarily. And that involves foreign exchange risk. And how do you deal with that? Well, there's futures, there's forwards, there's hedging. There's very specific tools and mechanisms that firms can engage in to really control the foreign exchange risk pretty definitely. So we'll spend a lot of time talking about that because this is a real concrete thing and it's a big deal for a lot of MNCs. We'll talk a little bit about the structure and operation of global financial markets. Firms need to raise capital to finance themselves in their home country, but they might find it advantageous to get capital to get funding in the countries where they're operating. So we want to know about loans, stocks, and bonds and how they work in different countries. And then finally, we'll look some at financing for MNCs and with a particular context of capital financing and financing imports and exports. Okay, so we're going to spend the bulk of our time. I'll put 3 stars here talking about the foreign exchange issues. This is the big one. We spend more time on it because it's kind of more technical. There's a lot of very specific tools and methods that are in place that we want to be aware of. And then I'll put 1 star each on these other topics. Pretty important, but they're a little more abstract. And these are things we want to be aware of. We just want to know about them. But this is stuff where there are specific tools and models that we want to be able to apply. So this class is not strictly about foreign exchange, but that's going to be a big part of what we're doing. So we will jump into that in Unit 2, but we'll spend a couple more weeks thinking about the global business environment. Look forward to seeing you next week.